Benjamin Graham survived the 1929 crash, the Great Depression, 2 world wars, and multiple recessions without ever being financially destroyed. The people around him, many of them smarter, better connected, and better resourced, did not all share that outcome. Some of them lost everything. Some rebuilt partially and spent decades recovering ground they should never have surrendered. The difference between Graham and the people who did not survive was not talent, it was not access. It was one principle that he identified, articulated, and applied to every financial decision he made for the rest of his career. He called it the margin of safety. In the decades since Graham first wrote about it clearly, this principle has been cited more often than almost any other idea in serious financial literature. Warren Buffett has called it the 3 most important words in investing. Charlie Munger built his entire framework for decision making around a version of it. And yet, despite how frequently it is referenced, despite how many times it appears in books and interviews and conversations about money, almost nobody applies it the way Graham intended. They apply it to stocks. They do not apply it to their lives. And that gap between knowing the concept intellectually and actually living by it in every financial decision is where most people's financial plans quietly come apart. That is what I want to close today, because the margin of safety is not a stock picking technique. It is a philosophy about how human beings should relate to uncertainty. And uncertainty is not a feature of financial markets alone. It is a feature of every decision you will ever make with money. Every loan you take on, every investment you commit to, every structure you build or fail to build, every assumption you embed inside a financial plan without stress testing it. The only question that matters in any of those moments is whether you have built enough distance between your current position and the point where a mistake becomes seriously damaging. Stay with me, because what we are going to cover today will change not just how you think about investing, but how you approach every financial decision you will make for the rest of your life. Graham came to the margin of safety through personal experience of the kind that leaves a permanent mark. By the late 1920s, he had built a significant financial position. He was not careless. He was not uninformed. He was, by most accounts, one of the most analytically rigorous investors operating on Wall Street at the time. And he watched his portfolio collapse in 1929 alongside nearly everyone else's, not because he had picked bad businesses. He had picked reasonably good ones. He lost because he had not built enough distance between his positions and the point of real damage. He had been right about the companies. He had been wrong about how much room he had left himself to be wrong before it cost him everything. That experience did not break him. It educated him in the way that only real losses can educate a person. He spent the years that followed rebuilding, rethinking, and reconstructing an approach to capital that would never again leave him exposed to that kind of collapse. What emerged from that process was a methodology that placed the management of downside risk at the absolute center of every decision, not as a secondary consideration after identifying the opportunity, as the first and most important question before any commitment of capital was made. He wrote that the function of the margin of safety is to render unnecessary and accurate forecast of the future. Read that carefully. He was not saying that thinking rigorously about the future is useless. He was saying that a truly sound financial structure should not depend on your ability to predict it accurately, because you cannot predict it accurately. Nobody can. Any approach to money that requires accurate forecasting in order to survive is an approach that will eventually fail, because the future will always deliver developments that no model anticipated and no projection included. This is where most people's financial lives go wrong, not because they are reckless or unintelligent, but because they build financial structures that require things to go roughly as planned. They take on mortgage payments that are manageable only if income holds steady. They carry credit card balances that are sustainable only if no unexpected expense arrives. They invest in position size so aggressively that a significant market decline creates real hardship rather than temporary discomfort. They operate with no meaningful cushion between themselves and the edge. And then they are surprised when the future, which has never once behaved exactly as projected, fails to cooperate with the plan built around it. Graham's answer to this was not to become paralyzed by the fear of what could go wrong. His answer was to build enough distance between your current position and the point of real damage that the surprises, when they inevitably arrive, land outside the boundary you have established rather than inside it. That is the entire principle. Everything else is the application of it. Let me make this concrete, because Graham always insisted that abstract principles without concrete application were not principles at all. In stock investing, the margin of safety works as follows. You analyze a business carefully and determine that its intrinsic value, meaning what it is truly worth based on its assets, earnings power, and long-term prospects, is $100 per share. You do not then pay $100 per share. You wait until the market price has fallen far enough below that intrinsic value to give you a meaningful cushion. Perhaps you buy at $65. The difference between what you pay and what the business is actually worth is your margin of safety. If your analysis turns out to be slightly wrong, if the business is worth $85 rather than $100, you have still paid $65, you still hold a profitable position. Your analytical error did not destroy you because you had built enough distance between your entry point and the point at which you would face a real loss. Now, apply that exact same logic to your personal financial life, not as a metaphor, as a literal operating principle. When you take on a monthly mortgage payment, what is your margin of safety? How far can your financial situation deteriorate before that payment creates a structural crisis? If your income dropped by 25% tomorrow, would you still be able to service that debt without serious stress? If the answer is no, you are operating without an adequate margin of safety in your housing structure. You are depending on the future to cooperate, and the future, as Graham spent a career carefully documenting, has no obligation to cooperate with anyone's financial projections. When you commit capital to a business, a real estate deal, or any significant investment, how wrong can your projections be before the investment produces a loss rather than a return? If your occupancy rate needs to be 90% or higher for the deal to generate positive cash flow, and actual occupancy comes in at 75% because of something you did not anticipate, where does that leave you? That is not a rhetorical question. That is the first question Graham would have asked before a single dollar was committed to any deal. The margin of safety is not pessimism. Graham was not a pessimist. He built one of the most successful investment records of his era and trained the people who went on to build some of the most remarkable records of the following generation. He was truly optimistic about the long-term productive capacity of well-run businesses and well-structured financial systems, but he was an absolute realist about the unpredictability of the short term. And he understood clearly that the short term is when damage actually occurs. Long-term wealth is built through compounding. Long-term wealth is destroyed through short-term catastrophes that you were not positioned to survive. The relationship between those two facts is the heart of everything he taught. You cannot benefit from long-term compounding if a short-term event removes you from the game before the compounding has time to work. Preserving the ability to stay in the game is not a defensive posture. It is the prerequisite for every growth strategy performing the way it is designed to perform. Let me now go through the three areas where this principle applies most directly to the financial decisions most people make, because this is where the distance between understanding the concept and actually living by it becomes most consequential. The first area is debt. Graham had a nuanced relationship with debt that is frequently misrepresented. He did not believe that debt was inherently destructive. He understood that leverage, used intelligently, could amplify returns in ways that equity alone cannot achieve. But he was completely uncompromising about one structural requirement. You should never take on a debt obligation that you could not comfortably service, even if the income or assets supporting that debt decline meaningfully from its current level. In practice, this means that if you are buying a rental property using financing, you should be able to cover the full debt service from rental income, even if the property operates at 60 to 70% occupancy, not 90. If you are borrowing to fund a business, that business should generate enough cash flow to service the debt, even in a year where revenue comes in well below your base case projections. If you are carrying any personal debt obligation, your fixed monthly commitments should represent a fraction of your income that leaves substantial room for that income to decline without triggering a structural failure in your finances. Consider what this looks like in practice for the average household. A family earning $10,000 a month commits to fixed debt payments of $8,000. On paper, the numbers work. Income covers obligations with room left over, assuming the income stays exactly where it is, assuming no major unexpected expense arrives, assuming nothing changes in the economic environment that affects either income or cost. Every single one of those assumptions must hold simultaneously for the structure to function. Graham would look at that arrangement and see not a financial plan, but a collection of dependencies, any one of which, if it failed, would cause the entire structure to collapse. There's no distance between the current position and the edge. There's no margin of safety. The second area is investment sizing. This is where even experienced investors frequently violate Graham's core principle. The margin of safety is not only about what you pay for an asset relative to its intrinsic value, it is also about how much of your total capital you commit to any single opportunity, regardless of how compelling that opportunity appears at the moment of decision. Graham was deeply skeptical of heavy concentration in individual positions, not because diversification always produces the highest returns, but because concentration creates a structural condition where a single error in judgment, a single unforeseen development, or a single instance of the future failing to deliver what was projected can produce damage that cannot be recovered from within any reasonable time frame. Damage that cannot be recovered from in a reasonable time frame interrupts the compounding process. That is the actual mechanism through which wealth accumulates over time. He was not suggesting that you spread capital so thin that no individual position could generate meaningful returns. He was insisting that you size each position based not primarily on your confidence in it, but on how much damage you could absorb if it failed completely. Each commitment of capital should be sized so that even a total loss of that position leaves the overall financial structure intact and capable of continuing to compound. That changes the primary question you ask before investing from how much can I make to how much can I lose without it stopping me from continuing to build. Now here is where I want to address something that most discussions of this principle completely skip over because it is the subtlest application of the margin of safety and the one that Graham himself spent the most intellectual effort explaining clearly. Every financial decision you make rests on a set of assumptions about how the future will unfold. Your investment projections assume a certain growth trajectory. Your retirement plan assumes a certain average rate of return over a certain number of years. Your business plan assumes a certain level of market demand and competitive stability. Your real estate analysis assumes a certain level of rental income, expense control, and financing availability continuing into the future. The mistake most people make is not that they make assumptions. You cannot make any significant financial decision without them. The mistake is that they commit capital based on assumptions. They have never explicitly stress tested. They build plans that perform well when the assumptions are correct and collapse when the assumptions are wrong by even moderate amounts, without ever having examined what a moderate deviation from those assumptions would actually look like in practice. Graham's approach was to do exactly that examination before committing to anything of consequence. He would identify the conditions under which a decision would produce a real loss, not just below target performance, but actual structural damage, and then ask whether those conditions were realistic possibilities. If they were, he would ask whether he had built enough distance between his position and those failure conditions to survive their arrival. If his structure required assumptions to be substantially correct in order to survive, he would either rebuild the structure to create a real cushion, or he would walk away from the opportunity entirely. Not because the opportunity lacked merit, because the structure was not safe enough to justify the commitment. This is precisely what he meant by rendering unnecessary an accurate forecast of the future. Your financial structure should not require your forecast to be accurate in order to survive. If the key assumptions are wrong by 20%, the structure should still produce tolerable outcomes. If they are wrong by 30%, it should still hold together. Only at some extreme deviation from your projection should things begin to face serious stress. And even then, the failure should come gradually rather than suddenly, giving you time to recognize what is happening and respond before the damage becomes irreversible. Graham understood something important about why people consistently build structures without adequate cushions. The reason is not ignorance. It is the natural combination of optimism and the desire to maximize. When you believe in an opportunity, your instinct is to commit to it as fully as the numbers appear to support, to take on as much debt as the income can service under favorable conditions, to concentrate as heavily as possible in the best opportunity you can identify, to build projections around what you expect to happen rather than around what you could survive if the outcome falls well short of expectations. That instinct feels like conviction. It feels like the behavior of someone who truly believes in what they are doing rather than hedging out of uncertainty. And Graham acknowledged clearly that it sometimes produces extraordinary results in the short term. But he documented with the patience of someone who had personally experienced both outcomes that it reliably produces serious failures when conditions shift in ways that were not accounted for. And conditions always shift eventually. That is not a possibility to plan around, it is a certainty to plan for. His solution was to separate your optimism about the opportunity from your conservatism about the structure. You can be truly enthusiastic about a business, a property, or an investment idea while simultaneously insisting that the financial structure you build around that commitment can survive being materially wrong. Those two orientations are not in conflict. In fact, Graham argued that the most financially resilient individuals are precisely those who hold both of them at the same time without allowing one to compromise the other. Enthusiastic about the upside, disciplined and uncompromising about the downside, unwilling to let the excitement of an opportunity erode the structural requirements of safety. The practical discipline that flows from this is one that Graham applied consistently throughout his entire career. Before committing capital to anything of real significance, he would explicitly identify what could go wrong and how wrong it would need to go before the situation became truly damaging rather than merely disappointing. He would map the distance between his current position and the cliff edge, and if that distance was not sufficient, he would create more of it or he would not proceed. This is the discipline that allowed him to survive 1929, financially intact enough to rebuild. It is what allowed him to navigate the Depression, build a record that stood for decades, and train a generation of investors who went on to build records of their own. He survived not because the conditions he faced were less severe than those that destroyed others. He survived because he had built enough structural distance between himself and those conditions to absorb their impact without being removed from the game. The margin of safety is not a complicated idea. That is part of its enduring power. Graham emphasized repeatedly that the most important principles in financial life are simple ones that people fail to apply consistently, not because they fail to understand them, but because applying them requires accepting a constraint that feels uncomfortable in the moment, the constraint of not maximizing, the constraint of leaving room to be wrong, the constraint of building a structure designed to survive the difficult scenario rather than one designed only to perform well in the favorable one. That constraint always feels like a cost when you are looking at an attractive opportunity, and the future still appears predictable. It feels like returns being left on the table, like excessive caution. It feels that way right until the moment when conditions change, and the person who accepted that constraint experiences discomfort, while the person who rejected it experiences a crisis. The compounding difference between discomfort and crisis, sustained across a financial lifetime, is the difference between building something lasting and watching it erode in precisely the moments when you can least afford the erosion. Graham spent his entire career making that case, not with dramatic urgency, with the quiet, methodical consistency of someone who had seen both outcomes clearly and retained no uncertainty about which one deserved to be recommended. He wrote that investment is most intelligent when it is most businesslike. What he meant is that the most financially resilient individuals approach every commitment of capital with the same clear-eyed discipline that the best-run businesses apply to managing their balance sheets, their reserves, and their exposure to conditions they cannot predict or control. Not because they are afraid, because they understand that the ability to survive a difficult period is what determines whether the productive periods have enough time to compound into something that truly and permanently changes the trajectory of a financial life. That understanding is the margin of safety, not as a formula to be applied mechanically in one specific context, as a philosophy about what intelligent behavior looks like when consequential decisions are being made in a world where the future is uncertain and will remain so regardless of how carefully you prepare. You now have that philosophy clearly in front of you. The question Graham would ask is not whether you understand it, the question is whether you will apply it to your next investment, to the debt structure you currently carry, to the assumptions embedded inside your financial plan, to every commitment of capital that carries consequences you would prefer not to experience. Build the cushion before you need it, because the moment you need it is precisely the moment you can no longer build it. That was a rule Benjamin Graham never broke. And it is the reason he was still building when others had already finished starting over. If this changed how you think about your own financial structure, put it to work this week. Pick one area, one debt obligation, one investment position, one core assumption inside your financial plan, and ask Graham's question: how wrong can I be before this becomes a problem I cannot recover from? The answer to that question tells you exactly how much work you still have to do.